Hello viewers, welcome to my channel. I'm Hasham Ali Khan. So last video I have completed two main problems on ratio analysis. In this video I'm continuing the third and fourth problem on this ratio analysis, main problem. So before this I have already uploaded the problems, short problems. 14 short problems I have explained you in detail regarding the ratio analysis. Hope my regular viewers are already watching one after another. Then only you can be able to understand. If you join in between, you will not be able to understand. So go to the playlist of my channel, select the subject financial decision making, select the topic ratio analysis, watch the initial videos on theory, be perfect on all the formulas, then you can start the problems. Now, third problem. Before starting problem number 3, I expect my viewers to have a printout of the problems which I have given in the link under my description. Always keep ready the problem. Take the screenshot of the solution of third and fourth problem, then I'll explain. Now, see the problem number 3. From the following details pertaining to J Limited, calculate gross profit ratio, net profit ratio, operating ratio, current ratio, asset test ratio, stock turnover ratio, receivables turnover ratio, and return on investment. These many ratios we have to calculate. What information is given? Statement of profit and loss of J Limited for the year ended. So profit and loss statement is given. Revenue from operation 1,80,000, other income 5,000. Total is 1,85,000. Total revenue. Expenses. Purchase of stock in trade, change in inventories. Change in inventories is given positive 10,000. When it will have positive 10,000, if the closing stock is less than opening stock. If closing stock is less than opening stock, then only we will have positive, right? Then employee benefit expense and finance cost, other expenses. Profit is 35,000. Balance sheet is given. Equity and liability, shareholders fund, share capital, reserves and surplus. Non-current liabilities are not there. Current liability 20,000, total 1,25,000, liability side. Assets, non-current assets, fixed assets, tangible fixed assets 70,000. Current assets are inventories, trade receivable, cash and cash equivalent. Total of the asset side 1,25,000. That's it. So we are given the profit and loss statement, we are given the balance sheet, and we have to calculate the given ratios. One by one we can easily calculate. First ratio, it is asking you gross profit ratio. The formula for gross profit ratio, gross profit by revenue from operation into 100. But we are not having gross profit. Revenue from operation is given, but gross profit we don't have. So we have to calculate gross profit. How to find out? Gross profit is equal to revenue from operation minus cost of revenue from operations. Remember, revenue from operation minus cost of revenue from operation will get the gross profit. So cost of revenue from operation, this we can get by using stock, purchase of stock in trade and change in inventories. Change in inventories we have positive 10,000. So purchase of stock in trade plus change in inventories. 1,05,000 plus 10,000, 1,15,000 is the cost of revenue from operations. Now, gross profit is revenue from operation that is given in the problem 1,80,000 minus cost of revenue from operation 1,15,000. So 65,000 is the gross profit. Now we can substitute. Gross profit ratio is equal to gross profit 65,000, revenue from operation 1,80,000 given in the problem. So 36.11% is the GP ratio, gross profit ratio. First, complete it. Secondly, net profit ratio. Net profit divided by revenue from operation into 100. Net profit is given in the problem, that is 35,000. 35,000 is the net profit divided by revenue from operation 1,80,000 given in the problem. Then 19.44 is the net profit ratio. Next comes operating ratio. Operating ratio formula, cost of revenue from operation plus operating expenses divided by revenue from operations into 100, because this is a profitability ratio, multiplied by 100. Cost of revenue from operation already you have calculated 1,15,000. operating expenses not given in the problem. We have to find out. So in the expenses, don't take finance charges. Apart from finance charges, we have employee benefit expenses and other expenses. So operating expenses is equal to employee benefit expense and other expense. Add up 33,000 rupees is called operating expenses. Now simply we substitute. Operating ratio is equal to cost of revenue from operation 1,15,000 and 33,000 is the operating expense divided by revenue from operation 1,80,000 given in the problem into 100. 82.22%. That is the operating ratio. Next it is asking you current ratio. Very easy. Current assets by current liabilities. Current assets are given always three: inventories, trade receivable, cash and cash equivalent. So here I have taken inventories, trade receivable, cash and cash equivalent 55,000. And current liability only one is given 20,000. So current ratio 55 divided by 20, 2.75 is to 1. That's it. Next comes acid test ratio. This is also called quick ratio. So quick assets by current liability. Quick asset means current asset minus inventory. Deduct the inventory. Total current assets are 55,000 and inventory is 15,000. So 55 minus 15, 40,000 is the quick asset. And current liability is same, 20,000. So 40,000 divided by 20,000, 2 is to 1. This is the liquid ratio or quick ratio, acid test ratio. Next is stock turnover ratio. The stock turnover ratio is cost of revenue from operation divided by average stock. Cost of revenue from operation already we have calculated 1,15,000. The only thing is average stock. Here average stock means opening stock plus closing stock divided by 2. Now remember, the change in inventories is given as positive value. That means the closing stock is less by 10,000. What is the closing inventory? In the balance sheet you can see inventory was 15,000. The end of the year closing inventory is 15,000 and it is reduced by 10,000. The beginning of the year how much? 15,000 plus 10,000. 25,000 was the opening inventory. Opening inventory is 25,000. So closing inventory 15,000. Add change in inventory 10,000. We are adding because it is given positive value. It is given positive value. So opening inventory is 25,000. So we have opening inventory 25,000, closing inventory 15,000. So average inventory will be 20,000. 25 plus 15 divided by 2, 20,000. Now we can substitute stock turnover ratio is equal to cost of revenue from operations 1,15,000 divided by average stock 20,000, 5.75 times. This is the stock turnover ratio. The next is receivables turnover ratio. It is asking you to calculate receivables turnover ratio. The formula is credit revenue from operation divided by average receivable. This is the original formula. But we don't have sufficient information. So simply we take revenue from operation and closing receivables. We are not calculating average because opening receivables are not given. So we can substitute closing receivable. So 1,80,000 is revenue from operation, closing receivable 25,000. 7.2 times is the receivables turnover ratio. The last ratio is return on investment, ROI. Return on investment is also known as return on capital employed. Both mean same. The formula is PBIT divided by capital employed into 100. So PBIT, profit before interest and tax. How to find out PBIT? PAT plus interest plus tax. Already in previous so many problems we have applied this. So PAT is 35,000 given in the problem. Profit is given 35,000. Interest means finance charges. So finance charges are given 2,000. In the problem 2,000 are given. Tax is not given. So 37,000 is the PBIT. And capital employed is equal to share capital. Actually, original formula for capital employed is equity share capital plus preferential capital plus undistributed profit plus reserves plus long-term liabilities minus fictitious asset minus non-current assets. But we don't have any information. So we have information only about share capital and reserves. So we add up share capital and reserves to get capital employed. So share capital 50,000, reserves 55,000. 1,05,000 is the capital employed. We don't have long-term debts. If long-term debts are there, that would have been included. So ROI, the PBIT 37,000 and in capital employed 1,05,000. 37 by 105 into 100, 35.24. This is the return on investment. That's it. This is the end of problem number 3. Now, problem number 4. Calculate the following ratios for the balance sheet of Mannan Limited given below. So A, B, C, D, E. Only 5 ratios it is asking you. Debt equity ratio, liquidity ratio, fixed assets to current assets, fixed assets turnover ratio, fixed assets to net worth. That's it. The balance sheet is given. Equity and liabilities, shareholders fund. Then share capital 1 lakh, reserves and surplus 50,000. Secured loan, non-current liabilities are there. Secured loan. Current liabilities, 2 current liabilities, trade payable, provision for tax. The total of liabilities 3 lakh. Asset side. Fixed assets. Tangible assets 1,40,000, intangible assets 60,000, and advances given 10,000. Current assets are only 2, that is inventories and cash equivalent. Below the balance sheet, we are given the information regarding sales. Sales for the year 5,60,000. This 5,60,000 is the revenue from operations. That's it. The 5 ratios it is asking you to calculate. The first ratio is debt equity ratio. The formula for debt equity ratio is long-term debt divided by shareholders fund. Long-term debt, secured loan, it is given non-current liability. The non-current liability are long-term debt. So secured loan we have 80,000. And shareholders fund. Shareholders fund consists of share capital and reserves and surplus. Only shareholders fund we need. So share capital plus reserves and surplus. 1 lakh plus 50,000, 1 lakh. Now debt equity ratio. Long-term debt divided by shareholders fund. Long-term debt is 80,000, shareholders fund is 150. So 80,000 divided by 1,50,000, 0.53. This is the debt equity ratio. The next is liquidity ratio. Liquidity ratio is called quick ratio. Quick assets by current liabilities. So quick assets. Quick assets means all current assets except inventory. Leaving the inventory, other current assets are the quick assets. In our problem, only 2 items are given. Inventory and cash equivalent. If you ignore inventory, only 1 current asset is there, cash and cash equivalent, that is the quick asset. The quick asset is equal to cash and cash equivalent. It comes to 60,000. Now current liabilities are 2 current liabilities are given. Trade payable and provision for tax. So trade payable 50,000, provision for tax 20,000, current liabilities 70,000. That's it. Now liquid ratio is equal to 60,000 by 70,000, 0.86 is to 1. So 2 ratios we have calculated. The third ratio is fixed assets to current assets. This formula is not there in the list which I have given, which I have explained. These are the peculiar ratios. The formula we can derive by seeing the wordings. See, the wordings are fixed assets to current assets. So it's clear, fixed asset divided by current assets. So fixed assets are 2, tangible and intangible fixed assets. Tangible are 140, intangible 60. 2 lakh rupees are the fixed assets. Current assets are only 2, inventories and cash equivalent. 30 plus 60, 90,000. Now substitute. Fixed assets to current assets, 2 lakh rupees divided by 90,000, 2.22. This is the ratio of fixed assets to current assets. The next ratio is fixed assets turnover ratio. This is the old formula, already we have applied in the previous problems. Revenue from operation divided by fixed assets. Revenue from operation is given, sales, 5,60,000. And fixed assets, just now we have calculated fixed asset 2 lakh. So 5,60,000 divided by 2 lakh, 2.80. This is the fixed assets turnover ratio. The last and final ratio is fixed assets to net worth. The formula, fixed assets divided by net worth. Fixed assets already we have here. How much? 2 lakh. Net worth. Net worth means shareholders fund. Remember, net worth means shareholders fund. Already we have calculated shareholders fund somewhere here. Here shareholders fund, 1,50,000. So you take 2 lakh divided by 1,50,000, 1.33. This is the ratio of fixed assets to net worth. That's it. So in this video, 2 problems, all the ratios I have explained in 2 problems, that is problem number 3 and problem number 4. Inshallah, we'll continue the next problem in the next video.